Listen, I'm going to tell you something that's going to change your financial life forever. If you have spare cash sitting in a bank account right now earning nothing, you're making one of the biggest mistakes of your life. I don't care if you're scared. I don't care if investing seems complicated. And I definitely don't care if you think you'll learn about it later. Later is too late. Every single day you wait is another day you're losing money to inflation while the wealthy get wealthier. I'm Kevin Hu, and I've been analyzing markets and managing investments for 10 years. I've seen people make fortunes by understanding simple principles, and I've watched countless others stay broke because they were too intimidated to start. The difference between these two groups isn't intelligence. It's not luck. It's action. And today, I'm going to give you everything you need to take that action. Before I reveal the exact strategy that will set you up for financial success in 2026, I need you to do something for me right now. Hit that subscribe button. Smash it. Because what I'm about to share with you is not watered-down beginner advice. This is the real roadmap that wealthy people use to build generational wealth. If you're serious about changing your financial future, subscribe now. And while you're at it, hit that like button and drop a comment telling me how much money you have sitting in cash doing nothing right now. I want to know because I guarantee most of you are hemorrhaging wealth without even realizing it. Here's what we're going to cover today. Why you must invest, how to invest, what to invest in, and the specific strategies that will make you money in 2026. This is going to be 20 plus minutes of the most valuable financial education you'll get anywhere. So pay attention. Take notes if you need to, because by the end of this, you're going to have zero excuses for not building wealth. Let me start with a brutal truth that nobody wants to talk about. If your money is sitting in a regular checking account or savings account earning basically nothing, you're not just missing out on gains. You're actively losing money every single day. Why? Because of inflation. The Federal Reserve targets an inflation rate of 2 to 3% annually. That's their stated goal. But let me tell you something. The real inflation rate is much higher. You can feel it in your daily life. You know what a Chipotle burrito cost 6 years ago? $8.50. You know what it costs now? Almost $12. That's a 40% increase in 6 years. Let me put this in terms that everyone can understand. If you had $50,000 in 2019, you could buy 5,882 Chipotle burritos with that money. Today, that same $50,000 only buys 4,166 burritos. That's 1,716 fewer burritos. Where did they go? Inflation ate them. Now, I know what you're thinking. Kevin, I'm not trying to buy 5,000 burritos. I get it. But this example illustrates a critical point. Inflation is quietly eroding your purchasing power. You're working just as hard. You might even be making a little more money, but you can buy less and less with the same amount of dollars. This is why keeping money in cash is financial suicide. You think you're being safe, you think you're being conservative, but you're actually guaranteeing that you'll get poorer every single year. Your bank account balance might stay the same or go up a tiny bit with that pathetic interest rate. But in real terms, in terms of what you can actually buy, you're going backwards. And here's what really kills me. Most people understand this conceptually. They know inflation exists, but they don't take action to protect themselves. They just accept that they're getting poorer and hope somehow things will get better. That's not a strategy. That's financial negligence. So how do you protect yourself? How do you ensure your money at least keeps up with inflation instead of losing to it? The answer is simple. You invest. You put your money to work in assets that grow faster than inflation. And historically, over the past 80 years, the stock market has returned approximately 8 to 10% annually. That's not speculation. That's historical fact. When you invest properly, you're not just keeping up with inflation, you're beating it. Your purchasing power is increasing, not decreasing. Your wealth is growing, not shrinking. This is the fundamental difference between people who build wealth and people who stay broke. Now, let me explain the second critical reason why you must invest. And this is where it gets really exciting. This is where the magic happens. Compound interest. Albert Einstein supposedly called it the eighth wonder of the world. And he was right. Here's how it works. Let's say you have $1,000 and you can generate a 10% annual return in the market. In the first year, you make $100. That's great, but it's not life-changing. You have $1,100 now. In the second year, you earn another 10%. But here's the key. You're not earning 10% on $1,000 anymore. You're earning 10% on $1,100. So you make $110. Now you have $1,210. If you keep this going for 20 years, reinvesting everything, never taking money out, you know what you end up with? $6,727.50. You turned $1,000 into almost $7,000 by doing nothing except leaving it invested and letting compound interest do the work. Now imagine you have $1 million and you're earning 10% annually. That's $100,000 per year in returns. $100,000 you didn't have to work for. You earned it through intelligent investing. That's passive income. That's wealth. And here's what really changes the game. The more money you have invested, the more money you make. It's exponential, not linear. When you have $10,000 invested, you're earning roughly $1,000 per year at 10%. When you have $100,000 invested, you're earning $10,000 per year. When you have $1 million invested, you're earning $100,000 per year. More money equals greater leverage. The returns increase proportionally with your principal. This is why wealthy people keep getting wealthier. They understand compound interest. They let their money work for them instead of working for money their entire lives. This is the system. This is how wealth is built. And if you're not participating in it, if you're sitting on the sidelines in cash, you're watching everyone else get rich while you stay broke. It's that simple and that brutal. Now you might be asking, Kevin, there are lots of investment options out there. Why should I focus on stocks specifically? Why not real estate or gold or collectibles or cryptocurrency? Great question. And here's the answer. For beginners, stocks are the best option for 3 critical reasons. They're easy to get started with, they have predictable long-term returns, and they're highly liquid. Let me explain liquidity because this is important. When an investment is liquid, it means you can easily convert it back into cash whenever you need to. If you buy a house with $500,000 in cash and then decide next week you want your money back, you're screwed. You have to list the property, find a buyer, go through the entire closing process. That takes at least 30 days, usually longer. Real estate is not liquid. But stocks are incredibly liquid. You can buy 1 share of Coca-Cola in the morning and sell it in the afternoon if you want. The money hits your account almost immediately. This flexibility is crucial, especially when you're starting out. You don't want your money locked up in illiquid assets when you might need access to it. Regarding predictable returns, I already mentioned that the stock market has historically returned 8 to 10% annually over the long term. That doesn't mean every single year is up 8 to 10%. Some years the market is up 30%, some years it's down 20%, but over time, over decades, the average works out to 8 to 10%. Compare that to real estate, where returns vary wildly by location and timing. Compare it to collectibles, where there's no predictable pattern at all. Compare it to gold, which doesn't generate cash flow and only goes up when people panic about the economy. Stocks, specifically diversified stock investments, provide the most predictable long-term returns of any mainstream asset class. And stocks are easy to get started with. You don't need $500,000 for a down payment like you do with real estate. You don't need to become an expert in authenticating rare art or vintage wine. You can start with as little as $1 in some cases. You can open a brokerage account on your phone in 10 minutes. There are no barriers to entry except your own hesitation and fear. This is why we're focusing on stocks in this guide, not because other investments are bad, but because for beginners who want to start building wealth immediately with minimal complexity, stocks are the optimal choice. Now let me explain what a stock actually is, because a shocking number of people don't understand this fundamental concept. When you buy a stock, you're buying a small ownership stake in a real company. You become a part owner of that business. If the company does well, your investment grows in value. If the company does poorly, your investment shrinks. Think about it this way. When you buy 1 share of Apple stock, you literally own a tiny piece of Apple. You own a fraction of their cash reserves, their intellectual property, their future earnings. As Apple generates profits and grows, your share becomes more valuable. That's why the stock price goes up. Some stocks also pay dividends, which are cash payments distributed to shareholders from company profits. So not only does your stock potentially increase in value, but you're also getting paid just for owning it. That's 2 sources of return: capital appreciation and dividend income. Now, buying individual stocks requires research. You need to understand the company's business model, their competitive advantages, their financial health. For beginners, this can be overwhelming, which is why I'm going to recommend something much simpler and much more powerful. Instead of trying to pick individual stocks, instead of trying to figure out which companies are going to be winners and which are going to be losers, I want you to invest in something called an index fund, specifically an S&P 500 index fund. What is the S&P 500? It's a collection of the 500 largest publicly traded companies in America. We're talking about Apple, Microsoft, Amazon, Google, Facebook, Tesla, Berkshire Hathaway, Johnson & Johnson, Procter & Gamble, Coca-Cola. The biggest, most successful, most profitable companies in the world, all in one investment. When you buy an S&P 500 index fund, you're buying a tiny piece of all 500 of these companies at once. You're instantly diversified across multiple sectors, multiple industries, multiple business models. If one company fails, it barely affects your portfolio because you own 499 others. If one sector struggles, other sectors pick up the slack. This is the strategy that Warren Buffett, one of the greatest investors of all time, recommends for average people. He doesn't tell them to try to pick stocks. He doesn't tell them to hire expensive financial advisors. He tells them to buy S&P 500 index funds and hold them for decades. And Warren Buffett knows more about investing than anyone alive. The historical annual return of the S&P 500 is around 8 to 10%, as I mentioned earlier. Some years it's up 25%, some years it's down 15%. But if you zoom out and look at any 20-year period in history, you always see growth, always, without exception. This is the power of investing in America's most successful companies. As long as the American economy grows, as long as these companies continue innovating and generating profits, your investment grows. It's that simple. So how do you actually invest in the S&P 500? You buy what's called an ETF. ETF stands for Exchange Traded Fund. Think of it like a basket that holds all 500 stocks of the S&P 500. You buy one share of the ETF and you instantly own a piece of all 500 companies. The most popular S&P 500 ETF is called VOO. It's issued by Vanguard. The expense ratio, which is the annual fee you pay for owning it, is incredibly low, just 0.03%. That means for every $10,000 you invest, you pay $3 per year in fees. $3, that's nothing. VOO tracks the performance of the S&P 500 almost perfectly. When the S&P 500 goes up 1%, VOO goes up 1%. When the market goes down 2%, VOO goes down 2%. You get the exact returns of the index minus that tiny fee. There are other S&P 500 ETFs like SPY and IVV. They're all essentially the same. They all track the same index. VOO just happens to have the lowest fees, which is why I prefer it. But honestly, any of them will work fine. The key point is this: instead of trying to pick winning stocks, instead of gambling on individual companies, you invest in VOO. You buy the entire market, and you let America's greatest companies carry you to wealth over time. Now let me address the biggest fear that stops people from investing. The fear of buying at the top. The fear that as soon as they invest, the market will crash and they'll lose everything. This fear is understandable. But it's also based on a fundamental misunderstanding of how successful investing works. Here's the strategy that eliminates this fear. It's called dollar cost averaging. Instead of investing all your money at once, you invest a fixed amount on a regular schedule. Every week, every 2 weeks, every month. Whatever works for your budget and your income. Let me show you why this is brilliant. Let's say you invest $500 every 2 weeks into VOO. Some weeks, the price of VOO will be high. You'll buy fewer shares. Other weeks, the price will be low. You'll buy more shares. Over time, you average out the price you pay. You're not trying to time the market. You're not trying to buy at the absolute bottom. You're just consistently buying, regardless of what the market is doing. This strategy has several massive advantages. First, it removes emotion from the equation. You're not panicking when the market falls or getting greedy when it rises. You just execute your plan. Every 2 weeks, like clockwork, you invest. Second, it ensures you buy more shares when prices are low. This is exactly what you want. When everyone else is panicking and selling, you're buying at a discount. When the market eventually recovers, and it always does, those shares you bought cheap are now worth much more. Third, it makes investing automatic. You set up the recurring investment once, and then it just happens. You don't have to think about it. You don't have to make decisions. The system does it for you. This is crucial because most people fail at investing not because they don't know what to do, but because they don't actually do it consistently. Dollar cost averaging is the strategy used by the most successful long-term investors. It's simple, it's effective, and it works in any market environment. Bull market, bear market, sideways market, doesn't matter. You just keep buying. Now let me teach you about the two main types of orders you'll use when buying stocks: a market order and a limit order. Understanding these is critical because using the wrong one can cost you money. A market order means you're buying the stock at whatever the current market price is, right now, immediately. You click buy and the transaction executes within seconds at the best available price. This is the simplest and most common way to buy. A limit order means you're setting a specific price at which you're willing to buy. For example, let's say VOO is currently trading at $610 per share, but you think that's too expensive. You can set a limit order to buy one share at $600. Your order will only execute if the price drops to $600 or lower. The advantage of a limit order is that you control exactly what price you pay. You never overpay. The disadvantage is that your order might never execute. If VOO never drops to $600, you never buy. You're sitting on the sidelines while the market potentially goes higher. For dollar cost averaging with index funds, I recommend market orders. Why? Because you're investing for the long term. Whether you buy VOO at 610 or 605 doesn't really matter when you're holding it for 20 years. What matters is that you actually buy consistently and let compound interest do its magic. Limit orders make more sense when you're trying to buy individual stocks at specific valuations. But for index fund investing, keep it simple. Use market orders. Execute your plan. Move on with your life. Now, let me tell you about the mistakes that destroy most beginner investors, because knowing what not to do is just as important as knowing what to do. Mistake number 1, trying to time the market. Beginners think they're going to be brilliant traders. They're going to buy low and sell high. They're going to catch every move. And you know what happens? They get crushed. They sell when they should buy. They buy when they should sell. They miss the gains and catch the losses. Time in the market beats timing the market. This is one of the most proven truths in investing. People who stay invested and ride out volatility make far more money than people who try to jump in and out. Stop trying to be clever. Just invest consistently and stay invested. Mistake number 2, panic selling during corrections. The market will fall. Guaranteed. It might fall 10%, it might fall 20%, it might even fall 40% like it did in 2020. And when it falls, beginners panic. They sell everything, they lock in their losses, and then they miss the recovery. Here's what you need to understand. Market corrections are normal. They're healthy. They're opportunities. If you're dollar cost averaging, a market correction means you're buying shares at a discount. That's a good thing, not a bad thing. The worst thing you can do is sell low and then buy back higher after the market has already recovered. Mistake number 3, not investing enough. Some beginners think investing $50 a month is going to make them wealthy. It's not. That's better than nothing, but it's not enough to change your life. You need to invest aggressively. I'm talking 15 to 20% of your income minimum. I know that sounds like a lot. I know it requires sacrifice, but this is the difference between building real wealth and just playing around. If you're serious about financial independence, if you want to retire early, if you want to stop living paycheck to paycheck, you need to invest aggressively. Mistake number 4, withdrawing money for stupid purchases. I see this all the time. Someone starts investing. Their portfolio grows to $5,000, and then they withdraw it to buy a new car or take a vacation or buy some gadget they don't need, and they've just destroyed years of compound interest growth. Your investment account is not a savings account. It's not money for purchases. It's money that's working for you, compounding, growing, building your future. Don't touch it. Don't withdraw it. Let it grow. The only time you should be withdrawing is when you actually need the money for retirement or a true emergency. Now let me tell you about the accounts that will supercharge your wealth building. Tax-advantaged retirement accounts. These are accounts where the government gives you special tax benefits to encourage saving for retirement, and you'd be crazy not to take advantage of them. The first is a 401k. This is an employer-sponsored retirement plan. You contribute money from your paycheck before taxes. Your employer might match some of your contribution, which is literally free money, and your investments grow tax-deferred until you withdraw in retirement. If your employer offers a 401k match, you must contribute at least enough to get the full match. Otherwise, you're leaving free money on the table. It's like getting a guaranteed return before your investments even grow. If you're not maxing out your employer match, you're making a massive financial mistake. The second is an IRA, individual retirement account. You can contribute up to $7,000 per year if you're under 50. There are two types, traditional and Roth. Traditional gives you a tax deduction now, but you pay taxes when you withdraw in retirement. Roth uses after-tax money, but grows tax-free forever, and you pay no taxes on withdrawals in retirement. For most young people, I recommend a Roth IRA. Why? Because you're probably in a lower tax bracket now than you will be in the future. You pay taxes on the seed, not the harvest. Your investments could grow from $7,000 to $700,000 over decades, and you pay zero taxes on that growth. Zero. That's incredibly powerful. Maxing out your 401k and IRA should be your first priority. Before you invest in a regular taxable brokerage account, max out these tax-advantaged accounts. The tax savings over decades will be enormous. So, let's talk about actually opening a brokerage account. This is where you'll buy your stocks and ETFs. There are several good options: Fidelity, Schwab, Robinhood, Vanguard. They all work. They all allow you to buy stocks with zero commissions. I personally use Robinhood for my taxable account because the interface is incredibly simple and easy to use. Everything is on my phone. I can buy stocks in seconds. It's beautiful. But Fidelity and Schwab are great too, especially for retirement accounts. Vanguard? I'm going to be honest. Their interface is terrible. It looks like it was designed in 1995 and hasn't been updated since. Everything takes too many clicks. It's clunky. I'd avoid Vanguard for the interface alone, even though they have a good reputation. Opening an account takes maybe 10 minutes. You enter your personal information, link your bank account, fund the account, and you're ready to go. Most brokers will let you start buying stocks as soon as you initiate the bank transfer, even before the money fully settles. Once your account is open, you search for VOO, or whatever S&P 500 ETF you've chosen. You decide how much to invest. You place your order, and boom, you're an investor. You own a piece of America's greatest companies. You're on the path to wealth. Here's the step that separates people who actually build wealth from people who just talk about it: setting up automatic recurring investments. Every brokerage allows you to do this. You specify how much money to invest and how often. Every week, every 2 weeks, every month, the system automatically buys shares for you on that schedule. This is the key to success. You set it up once, and then you never have to think about it again. You're not making emotional decisions. You're not trying to time the market. You're not forgetting to invest. The system handles everything. I cannot stress enough how important this is. The people who build wealth are the people who invest consistently over decades. Not the people who invest a bunch 1 month and then nothing for 6 months, and then a little bit again. Consistency beats intensity. Automatic investments ensure consistency. Set it up for every time you get paid. If you're paid bi-weekly, invest bi-weekly. If you're paid monthly, invest monthly. Match your investment schedule to your income schedule so you're never cash-strapped. And here's the psychological benefit. Once you set up automatic investments, you never see that money as available to spend. It's gone before you can waste it. Your lifestyle adjusts to your after-investment income. This is how you force yourself to save and invest, even when you don't feel like it. Now let me address the mindset required for successful investing, because all the strategy in the world won't help you if you have the wrong mindset. First, understand that investing is boring. It's not exciting. You're not going to get rich quick. You're not going to double your money in 6 months. Anyone promising that is lying to you. Real wealth is built slowly, consistently, over decades. If you're looking for excitement, go to Vegas. If you're looking for wealth, invest in index funds and be patient. The tortoise beats the hare every single time in investing. Second, ignore the noise. Turn off CNBC. Stop reading headlines about market crashes and bubbles and corrections. Stop listening to people who predict what the market will do next week or next month. Nobody knows. Nobody can consistently predict short-term market movements. All this noise will just make you anxious and cause you to make bad decisions. Third, think in decades, not days. I don't care if your portfolio is down 5% this week. I don't care if it's up 10% this month. What matters is the 20-year trajectory. What matters is whether you're consistently investing and letting compound interest work. Fourth, understand that volatility is the price of admission. If you want to earn 8 to 10% annually over the long term, you have to accept that some years will be down 20%. That's the deal. That's the trade-off. Higher returns come with higher volatility. If you can't handle volatility, you can't build wealth in the stock market. And fifth, remember that you're investing in the future of America and the world's greatest companies. As long as innovation continues, as long as companies continue creating value, as long as the economy continues growing over time, your investments will grow. You're betting on human ingenuity and progress. That's a pretty good bet. Let me paint you a picture of what successful investing looks like over time. You're 25 years old. You start investing $500 every 2 weeks into VOO. That's about $13,000 per year. After 10 years, assuming an 8% annual return, you'll have approximately $187,000. You invested $130,000 and compound interest added $57,000. After 20 years, you'll have approximately $630,000. You invested $260,000 and compound interest added $370,000. The compound interest now exceeds your contributions. After 30 years, you'll have approximately $1.5 million. You invested $390,000 and compound interest added over $1 million. The compound interest is now almost 3 times your contributions. After 40 years, when you're 65, you'll have approximately $3.3 million. You invested $520,000 and compound interest added $2.8 million. You're a multi-millionaire from investing $500 every 2 weeks. This is the power of starting early and staying consistent. This is why I'm telling you to start today, not tomorrow. Every year you wait is hundreds of thousands of dollars you'll never have in retirement. So here's where we are. You now know why you must invest. You know how compound interest works. You know that S&P 500 index funds are the best option for beginners. You know about dollar cost averaging. You know how to open a brokerage account. You know how to set up automatic investments. You have 0 excuses left. The only question now is, are you going to take action? Or are you going to do what 99% of people do, which is watch this video, think it's interesting, and then do nothing? I need you to commit right now, not tomorrow, not next week, right now. Pull out your phone, open Fidelity or Robinhood or Schwab, start the account opening process. Even if you can only invest $50 to start, do it. Take the first step. Break through the inertia. Because here's the truth. The difference between wealthy people and broke people is not intelligence, it's not luck, it's action. Wealthy people do the uncomfortable things that broke people avoid. They sacrifice today for freedom tomorrow. They invest consistently even when they'd rather spend. They stay patient even when they're tempted to quit. Which category do you want to be in? Because I promise you, 10 years from now, you're either going to thank yourself for starting today or you're going to regret that you waited. Now, I need you to do something for me. If this guide has given you the clarity and confidence to start investing, I need you to hit that like button right now. I need you to subscribe to this channel if you haven't already. And I need you to drop a comment below telling me you're committing to start investing. Write, "I'm starting today" in the comments. When you declare it publicly, you're more likely to follow through. This channel exists to give you real financial education, not theory, not complicated jargon, real actionable strategies that build wealth. If you want more content like this, subscribe and hit the notification bell so you never miss a video. And if you want to go deeper, if you want to see my actual portfolio, if you want to follow along with my investment journey and get access to exclusive content and analysis, check out the link in the description. Join the community of serious investors who understand that knowledge without action is worthless. Thank you for watching. Thank you for taking the time to educate yourself. Now go out there and take action. Open that account, make your first investment, set up automatic contributions, and start building the wealth that will change your life. Remember, the best time to start investing was 10 years ago. The second best time is today. Don't let another day pass watching from the sidelines while everyone else builds wealth. Your future self will thank you.